That's right. Disney goes ahead, reports some lovely earnings. You already know it. So in their after hours trading, it was a very choppy little after hours. Obviously, we were up at one point. It was up a good couple percentage points, and then it went straight back down. It was like, hey, no, I'm going down 4%. Then it was like, well, actually, I actually want to go up again. And then it realized, I just kind of want to putter off into nothingness. So, an interesting reaction to the conference call and just the earnings report in general, for sure. It's definitely an interesting little reaction, especially a day in which the market went up a good 2%. Naturally, Disney went up 2.5% just as is, but really after the after hours, it was up only 2% technically, so nothing crazy overall. Just a good day for them. But let's take a look at these earnings, see what was going on. Well, one thing too. So, as it should be mentioned, so Disney, Q1 non-GAAP EPS of $1.53 beats by 9 cents per share. But on a GAAP EPS standpoint, missed by 8 cents. They posted a $1.17 EPS. So, in my eyes, I think that is a perfectly decent number. I would consider it not too absurd. If you think about other companies in which streaming becomes such a big aspect of their business, which it certainly will be for Disney, most of those companies like Netflix, they're not profitable companies for the most part. These streaming companies, they don't make profit off their streaming. So, not all, but at least for a while, Netflix didn't. They're getting to that point finally, but still. Then we look at a revenue number of plus 36% year over year, and you might be thinking, well, excuse me, plus 36%. That's a ridiculous number. But overall, you see that estimate only beats by $50 million for a good reason, and that's because it's including now the revenue generated from Fox assets. So last year, in which they didn't have Fox assets impacting their earnings, they do this year. So that way, the revenue is going to look a lot higher this year than it did last year. So that is an impact on that, just in case you were curious why that revenue seems a little high. So Disney goes ahead, talks about some Disney Plus subscribers of 26.5 million. To be frank, I thought they were going to be hitting 30 million as of this earnings report, so I'm not disappointed, but I did think the number was going to be around 30 million. I'm not, too upset. 26.5 million is obviously, again, well ahead of the estimate of 20 million that they were expected. On top of that, ESPN Plus subscribers were 6.6 million. Hulu rose 33% year over year in subscribers to 30.4 million. That's pretty crazy. 27.2 for subscription VOD only, and 3.2 million who have the live TV package. So revenue grew by more than a third, while EPS fell 17%. Again, there's a good reason why EPS fell. It's because of the involvement in streaming. So no shocker there. Total segment operating income, though, rose 9% to $4 billion. So they did make $4 billion in cashish. Cash from continuing operations fell 22%, and this was off of just some investments they made, to $1.63 billion. Free cash flow fell 68% to $292 million. So not overall that much cashish being brought in profit-wise. Not absurd, but, it'll be okay. So then you're going to look, obviously, here in media networks. This is going to be where you get a lot of this benefit from Fox, which was up 24%. That's where you get the benefit from Fox assets. So that number makes sense. We don't really care about that one as much. Parks and experience and products. So that was up 8%, which is very good for parks. Parks revenue to be up that way. Studio entertainment up 106%, which again, it makes perfect sense because you had 3 films reach $1 billion in 2019. I mean, they absolutely rocked 2019 in the box office. Obviously, and that's just, including just this last quarter, though. You have Star Wars and Frozen, so that would be why you have such a high studio entertainment number there. So then the real one we want to look at is direct to consumer and international, because that's including the streaming, which was $4 billion, up 333 or 334%. Sorry, didn't mean to skew that a little bit. That is crazy, but again, a lot larger of a loss of money as we expected, just because of the nature of the business. So I don't think it's too crazy at all if you look at that. So looking at more fine details, what do we have to say? Obviously, with a decline in EPS, you look at obviously value of the shares, where you might be getting now a PE ratio on this company somewhere around 30, which you think for Disney it might be a little absurd. But in my opinion, I don't know if it necessarily is, because of the fact that it has really transformed their business. Disney Plus has transformed the business of Disney, and they're transitioning to where they can get a lot more from that consumer direct-to-consumer segment, as opposed to what they had prior, when they didn't really have anything necessarily that was for that besides Hulu. But again, Hulu, Disney Plus is raking in the dough. It's a big, big impact. I mean, nearly just as many subscribers on Disney Plus in a quarter than you had from Hulu so far in all its time. So Disney Plus is huge, and I think they need to certainly work on some new, and I don't know why I can't think of the word, but they need to release a new short series or film that is from them. It's exclusive. That's exactly what I meant to say, but I couldn't think of the word exclusive. That's really a good thing for them. I can't wait to see what happens there, but again, I don't think the value is crazy, just because of the fact that they've transformed into a more of a growth type business, in which many players in the market like this are actually overall, if you think about it, which is, I think, crazy, but players in the field like Netflix trading at a premium of freaking P ratio at 100, whatever it is, nonsense. I mean, there's a lot of these big tech companies that are trading just absurd premiums right now, so nothing's too crazy about Disney doing it, in my opinion. So as far as the charts goes, we'll see some comments from Bob Iger here real quick. We had a strong first quarter, highlighted by the launch of Disney Plus, which has exceeded even our greatest expectations. Thank you, Bob Iger. Thanks to our incredible collection of brands, outstanding content from our creative engines, and state-of-art technology, we believe the direct-to-consumer services, including Disney Plus, ESPN Plus, and Hulu, position us well for continued growth in today's dynamic media environment. And I think it certainly will. No doubt about it. So overall, you see a lot of decreases here, and this is a lot of this. The profit and just cash side of this business is going to decrease as they spend more on content. That's just simply how it goes. It's hard to make that much of a profit in that business. But overall, revenues were up 36% year over year. So nothing crazy. So where do you see a change in, obviously, revenues here? Wild stuff. Studio entertainment up over 100%. Direct-to-consumer over 100%. Look at these significant differences. You can see there from, let's see, in millions. So from $918 million to $4 billion, quite a big difference. But definitely interesting stuff. I like seeing it. So segment operating income, obviously you see that direct to consumer. Also, that line there where they increase their losses technically. So money lost off of that was, as opposed to 136 million, it was 693 million. So definitely a big increase in terms of money lost from that segment. So nothing's too absurd, and I kind of expected that. So that'll be all right. We don't care about cable networks and broadcasting with them, really. So parks, experiences, and products revenue for the quarter increased 8%. And segment operating income increased 9%. So very good for them. Definitely is a thing to consider, that there will likely be some headwind in the next earnings report for the park segment, simply due to the, as we all know, the coronavirus. Grab some Ronas with the boys. I think that'll be an impact in this parks and experience segment in the next quarter. So nothing super crazy this quarter, but just expect it next quarter. They might see a decline there. Studio entertainment increased from 1.8 billion to 3.8 billion. Insane stuff. That's really cool. Higher operating income was due to increases in theatrical and TV SVOD distribution results at a legacy operations, and partially offset by a loss from the consolidation of the TFCF business. Increase was due to Frozen 2, Star Wars Rise of Skywalker, compared to the previous quarter, or prior year quarter, when all I had was Ralph Breaks the Internet, and Mary Poppins and the Nutcracker and the Four Realms. Nothing crazy. Nothing too crazy. So that's really where you see the difference. This quarter had Frozen 2 and freaking Star Wars. So obviously you expect a lot more growth in terms of that. Nothing super wild. The increase in operating loss was due to costs associated with the launch of Disney Plus. No shocker. Consolidation of Hulu and the higher loss at ESPN Plus. These increases were partially offset by a benefit from the inclusion of the TFCF businesses, 21st Century Fox. In case you're curious, I'm kind of a genius, so I just knew what that stood for off the top of my head. The increase in operating loss at ESPN Plus was primarily due to high programming costs, primarily the UFC rights. So to get these UFC fights, which again, it's a big portion of it, keeps people subscribed. People really, instead of buying pay-per-view packages, it makes more sense to go with ESPN Plus, personally, in my opinion. I don't personally watch fights, but if I did, ESPN Plus would be the way to go. So that's very cool. So Disney Plus, obviously, 26 freaking 0.5 milo subscribers. ESPN Plus grew from a year ago over 100%, from 1.4 million to 6.6 million. Big stuff. Hulu, obviously, grew from 22.8 to 30.4. Love that overall. So average monthly revenue per paid subscriber from Disney Plus, they get right around $5.56 per subscriber. Love it. Hulu, they're actually getting, or ESPN Plus, they're getting $4.44 per subscriber. Nothing crazy, but nothing's, unexpected there. From Hulu, they're earning a little bit less per subscriber on the VODs category. So just the overall, just watching shows, nothing live. But on the live segment, they increased by 14% year-over-year revenue per. Obviously, a big portion of that live TV is big because it's supposed to get you off using your cable package. It's a lot cheaper. So, other financial stuff, nothing crazy. Restructuring charges, obviously, due to the 21st Century Fox acquisition. What else do we want to look at? Well, you know what? We're going to go ahead and look at, obviously, capital. We want to look at the money that they have. So, let's go down here, skip through a lot of these kind of nonsenses. And look at this chart here where you see assets, current assets. Obviously, we want to look at the cash and cash equivalents, in which they actually have more cash than they did last quarter, which is good, by over $1 billion, right around $1.5 billion, which is very cool. Accounts receivable higher, Love it. Inventory not higher, which is good to see. Um, so total assets of 27.7 billion. Cool stuff. Um, as opposed to, well, let's take a look at how about their total liabilities, right? So accounts payable of 19.7 billion, which is higher than what they had the last quarter. Um, Obviously, crazy stuff there. Total current liabilities of 34.8. Obviously, something to look at for sure. Nothing too crazy with that balance sheet though. I'm not upset at all by that balance sheet. So that's really all I got for you for Disney Plus. People are really gonna care in the future. It's all gonna be about Disney Plus in the future. I'll just tell you that right now. Their streaming is gonna be what dictates these earnings reports. I think overall Disney probably will be relatively just consistent with the market tomorrow. I'm recording this at like 2 a.m. So I'm tired as crap, but I think this will be who Disney's going to be following the market. I don't think there's going to be anything from this earnings report that's going to make it differ from what the market's doing. So if the market goes up, I think Disney goes up. If the market's going down, Disney's going to go down. I'm going to go pass out now, potentially, or maybe I'll make another video. Who knows? My eyes are closed. I'm falling asleep. Hope you enjoyed.